It's just that. So why is gold going up and the stock market going down and bonds being sold off, which is driving the 10-year up? Because lending money to the United States is no longer a flight to safety. The stock market is being revalued and demonetized. Scarce assets win. Scarce assets win. The market just hasn't understood Bitcoin yet. It hasn't decoupled. This is why my prediction this year is Bitcoin decouples from its very tight correlation to the stock market this year, because I believe the stock market is going to get revalued and Bitcoin is going to trade much more like gold, because all the unit of each fiat currency is going to explode up.
Something significant is unfolding in the financial markets. Gold is climbing to record levels, stocks are struggling, and bonds are experiencing a historic sell-off. The 10-year Treasury yield continues to rise, revealing an unsettling truth. Lending money to the US government is no longer the secure option it was. Investors are waking up to a harsh new reality. The old rules no longer apply. Jack Mallers, a prominent figure in the Bitcoin community, says the market still doesn't fully understand what's coming. Bitcoin remains tied to the stock market's fluctuations, but that's about to change. Mallers predicts that this year, Bitcoin will finally break away, behaving less like a speculative tech stock and more like digital gold. Why? Because trust in fiat currencies is fading fast, and the stock market is being brutally reevaluated. The message is becoming clearer. Scarce assets are the future. The rise of gold and Bitcoin's coming breakout are not just trends, they are signs of a larger financial shift. As confidence in traditional finance weakens, those holding strong, limited supply assets are in the best position to endure. The financial system stands at a crossroads, and the winners are already being chosen. Let's now watch clips from Jack Mallers' powerful interview for deeper understanding. Don't forget to like, subscribe, and turn on notifications for more insightful content. Thanks for being here. Enjoy the video.
Besant has said he's been focusing on the 10-year Treasury. This was not the plan. The plan wasn't stock market down 20%, assets down, 10-year up. That was not the plan. The plan was hopefully the Fed can cut, hopefully the 10-year comes down. They've got $9-10 trillion worth of debt that they got to refinance. And if you can get the cost of that capital down, if you got a $10 trillion bill that you got to work on, boy, would it be nice if you had lower cost to refinance it. So the goal was, we're going to be stiff, we're going to be firm, we're going to be focusing on Main Street and not Wall Street, yada, yada, blah, 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 blah. And we're going to get the 10-year down, we're going to refinance our debt, we're going to build from there. Okay, well, that didn't go too well, did it? Because stock market down 20%, but the 10-year up, 10-year up. What does that mean? If the 10 years up, guys, just bond math, we go up when like the actual bond goes down. So the more people sell these things, the more the rate goes up. Okay, that's how it works. It's inverse. So if everyone is interested in lending to the US government for 10 years, then the rate is going to come down. If everyone's like, I'll give the US government money, they're so responsible, they're so fast growing, they're so amazing, I'm not worried about their debt, they're the best, then 10-year yields is going to come down. If everyone's like, get me out, I don't know how the heck they are so indebted and just drowning in debt. And it's unclear how strong the dollar is going to be. It's unclear the future of monetary order. I don't want to lend to the US for 10 years. No chance. Get me out. Then the 10 years is going to go up. And so with the 10-year going up, that's a huge problem. Usually what the administration thought was going to happen is when stocks go down, people exit what they call risk and they find a flight to safety. Flight to safety used to be treasuries, okay? Used to be we go to where there is a return without any risk, right? Without any risk. Let's say the 10-year returns you 5%. The S&P on average return you 14%. So if risk is on, I'm in the S&P because I'm getting a higher number. If risk is off and I have to find a return where I don't want any risk, there could be a war, there could be COVID, there could be trade wars. If I don't want risk, usually the flight to safety are treasuries. But seeing that go up while stocks go down means people are fleeing treasuries and the stock market. Stocks down, 10-year up, gold up, huge problem. Let me try and unpack that for you guys. Stocks down, meaning, again, the US's new policy. I said this last episode. If you guys need a deeper dive into what I'm about to say, check out last episode. But the US's new policy is take your money and get the hell out of here to foreigners, to China. Let's talk about China. Take your money, get out. Okay, but China's money is in the US stock market and in treasury market. The US operates in a trade deficit. China operates in a trade surplus. China takes any foreign trading partner, takes their trade surplus and invests it outside of their local economy. If you take your profits from trade and you invest it internally in your local economy, you're going to strengthen your currency, which weakens your exports. You want a weaker currency so that you have cheap labor and stronger exports. So when you have profits from trade, you have to push the money out elsewhere. So China takes profits and they dump it into the US stock market. They dump it into the US treasuries market. Okay, we're all following so far. The US is saying, take your money, get the hell out. Okay, but their money is in Meta, is in Google, is in Amazon, is in Nvidia. So why is the stock market absolutely tanking? Well, they're following what the US wants. Take your money, get the hell out. How was US exceptionalism funded over the years? Why is the US stock market always getting bid higher than any other market? Do we have better technology? Do we have better companies? Yeah, maybe you can make that argument. But more of the reality is because everyone else's trade surplus with the United States was being dumped into the S&P 500. That's why. What's the wealth gap? Where's the wealth gap come from? Well, if you're a successful tech founder, you get a permanent bid from China on your stock. That's where you're getting 50 times earnings. So the stock market is going through a reevaluation. It's getting demonetized, revalued. Why? Because you're not getting the surplus of global trade just unemotionally dumped into the S&P 500. So the stock market comes down. Now, when the stock market comes down, people fly to safety. That safety this time is gold. Again, usually in recent history, a flight to safety is lending money to the US government in the form of something like a 10-year, right? What is a 10-year? It's here. US, I will lend you my money. You will pay me with interest. Okay? People overcomplicate it. It's you're lending to the government's borrowing money from you and they'll pay you back later. Okay. And you know it's risk free because they're paying you in dollars and they can print those things. So they can always make you whole on the interest that they owe. People aren't flying to that safety anymore. They're saying, screw that. The dollar, like these guys are a mess. They're indebted. The dollar is in trouble. We're out.
Bitcoin is staying calm while traditional markets are going through intense swings. Gold, oil, and stocks are all reacting sharply to macroeconomic and geopolitical tensions, but Bitcoin is holding steady. This type of calm is common during US holidays, but it also suggests reduced institutional trading activity and the absence of a major catalyst for crypto. Ether, meanwhile, is stuck in a downward trend after a week of losses. The 10-year Treasury yield keeps climbing, dragging stocks lower and boosting gold. The Federal Reserve's hope for a smooth economic landing is fading, and investors are selling off bonds, showing that faith in the US system is cracking. In this chaos, gold and Bitcoin are standing out two limited, non-printable assets that aren't under political control. As central banks continue printing money endlessly, these hard assets are becoming the backbone of a new financial reality. Jack Mallers points out that Bitcoin has outperformed the broader market and is no longer acting in sync with stocks or inflation-sensitive assets. As traders wait for updates on the trade war during the holiday, Bitcoin remains one of the few clear indicators in a market full of uncertainty and instability. Get ready, let's dive into more highlights from the interview.
What I think is going to happen is neutral reserve assets are going to explode in demand. Scarce neutral reserve assets, gold, Bitcoin. Gold, we're already seeing it. Why is Bitcoin trading like beta NASDAQ? People say Bitcoin just correlated to the stock market. It's not a neutral reserve asset. Okay, but what I think has actually been happening and will happen is the stock market and Bitcoin were expressions of fiat debasement. They were they were correlated with fiat liquidity, okay? Meaning when governments around the world were printing money or having trade surplus, the stock market and Bitcoin got the bid, okay? Is this making sense? So the reason they were so correlated is not because Bitcoin has earnings and trades like a company. It doesn't. In fact, it's a better version of gold. They don't trade similarly, or their correlations aren't so high because they have similar properties, because they have similar value in a portfolio. They trade similarly because they are both smoke alarms for fiat liquidity, for currency debasement. But the stock market is very quickly not becoming that because they're not catching the permanent bid from excess trade flows. They're not getting the permanent bid from surplus from countries like China. Bitcoin is and will. So I see them decoupling because I like the NASDAQ. I would not be very long the NASDAQ because how are you going to replace the flow of capital that is China? You know, that's a lot of money that you're going to have to find a lot of new buyers. That's not going to take a Robinhood Reddit thread to replace China buying the equities in your portfolio. If the new monetary order in alignment around the world is take your money, go home, our country first. We have to focus on local production. We have to focus on manufacturing. We have to make America great again. Then your equity isn't trading at 50 times earnings. It's just not. Bitcoin will still catch that bid though, because in this world, what do you want to own? You don't want to own some tech company trading 50 times multiple. You want to own a scarce asset. Because guys, here's the game. The game is focusing on my country first, saying we're going to focus on manufacturing. We're going to focus on building real things and exporting them. That's really inflationary because the only way you can be competitive in producing stuff and selling it is if your currency is weak, if you can afford cheap labor. Guys, think of it this way. How the hell is the United States going to afford to build factories, to localize production of stuff? They're going to have to print the money. They're going to have to print the money. And whether that looks like yield curve control, whether that looks like stimmy checks, if Trump comes out and says, hey, we need 2 million factory workers in the next 24 months. And so the first million that enroll get free tuition, they get guaranteed salary, and they get housing in Texas. That's printed money. They're going to have to print it. So if the game is every fiat currency is going to get weaker, there's going to be more fiat currency units that exist in the world, then the game is not necessarily pick the right tech stock anymore. That's been the game because everyone's trade surplus gets plowed into the United States. And the way the media pitches it to you is this is US exceptionalism. The US is just so exceptional at everything. Not really. US exceptionalism has been funded by foreigners' trade surpluses. But the reality of the game is, guys, if the US is starting to devalue the dollar, then everyone else around the world has to devalue their currencies and keep printing, because it's a game of who has the weakest currency, who has the strongest manufacturing and production, who has the strongest exports. And so there's going to be money printing everywhere. It's a money printing competition. And that's why gold, all of a sudden, gold is kicking the S&P 500's butt. This time last year, the S&P 500 mocked and laughed at gold. You look like a clown owning gold. That changed that quickly. And I'm just trying to break it down and humanize it and explain it to you guys. Bitcoin's going to be much more like gold, and then it will outperform gold. Because the reason Bitcoin will outperform gold is it's harder than gold. And harder is in reference to how hard is it to produce more units. Okay, Bitcoin, it's impossible to produce more units. Gold, it's not impossible. The more gold goes up, the more gold we will find. Right now, it's uneconomical for Elon Musk to go to a planet in outer space and find a bunch of gold. It would cost him too much to do that versus what he would get in return based on what gold is worth. If gold keeps going up, us humans are going to find a lot more of it. If Bitcoin keeps going up, us humans can't make any more of it. We can't. It's the only thing where no matter the amount of demand, we can't change the supply. We can't find it in the ground. We can't find it in Mars. We can't produce it in a factory. There's 21 million. That's it. And so Bitcoin will decouple from the stock market. It will start trading like gold. It will outperform gold. And then the question will be, if we need to start to settle and denominate in world reserve assets, who's going to want to use gold? Who's going to want to use Bitcoin? And I think initially, central banks already owned gold. There was a period in human history where we used gold, but Bitcoin is a better product. It's more divisible. It's more portable. It's easier to transfer. It's cheaper to use. It's more private. It's all the things that and it's most importantly, it's harder. It's scarcer.
Bitcoin is staying calm while traditional markets are going through intense swings. Gold, oil, and stocks are all reacting sharply to macroeconomic and geopolitical tensions, but Bitcoin is holding steady. This type of calm is common during US holidays, but it also suggests reduced institutional trading activity and the absence of a major catalyst for crypto. Ether, meanwhile, is stuck in a downward trend after a week of losses. The 10-year Treasury yield keeps climbing, dragging stocks lower and boosting gold. The Federal Reserve's hope for a smooth economic landing is fading, and investors are selling off bonds, showing that faith in the US system is cracking. In this chaos, gold and Bitcoin are standing out, two limited, non-printable assets that aren't under political control. As central banks continue printing money endlessly, these hard assets are becoming the backbone of a new financial reality. Jack Mallers points out that Bitcoin has outperformed the broader market and is no longer acting in sync with stocks or inflation-sensitive assets. As traders wait for updates on the trade war during the holiday, Bitcoin remains one of the few clear indicators in a market full of uncertainty and instability. Get ready, let's dive into more highlights from the interview.